Right, hello, thanks for listening to today's podcast. This podcast is brought to you by Trend Signal, the award-winning indicator and coaching company, helping individual traders get better results and outcomes from their trading. Remember to attend our live trading webinars to learn one of our trading strategies and hear more live market analysis. You can book your free place at one of this week's events on trend-signal.com. So my name is Adrian Boothie, I'm the head of trading here at Trend Signal, and I'm here with Jerry Miller, Trend Signal's CEO and Chief Market Analyst. So, well look Jerry, what's been going on this week? We've had a lot of data, let's give us your highlights.
Okay, yeah, just looking at the data from last week is I guess what you're referring to. We were beset, or the markets were beset with the impeachment hearings into Donald Trump. Impeachment basically is a way of Congress removing or censoring the incumbent president, whether he's or she has abused their position in some way. In Trump's case, it's to do with Ukraine, and it's already been given that gate, Ukraingate, Watergate, whatever it is. It's got a gate in front of it, or at the end of it. At the end of it, I should say, yeah. So, and what happened over the weekend as well, another whistleblower emerged. I think that was yesterday, so that's Sunday. A second whistleblower has emerged saying that, yeah, Mr. Trump's done this, that and the other. He regards it as a witch hunt. He's regarding...
Everything's a witch hunt.
Well, it is, yeah. When you look at Nancy Pelosi, she sort of looks like a witch, doesn't she? But he's suggesting that she's committed treason, and it's all a bit weird, really. But my suspicions are that this will play on and on and on, and eventually it'll come to a conclusion that will not remove Trump from his position as president. So it's a very much a Democrat-inspired way of just undermining the president.
Yeah, although he's been trying to
undermine himself, really.
Well, yeah, he's good at that. Okay, and what else then? So a bit of data last week as well, wasn't there? So generally quite negative. And I know we talked about the podcast last week about sort of a lot of red items the week before, and kind of again last week.
That's pretty much the way of it at the moment. There were mostly red items. When I say red items, data events or data releases, I should say, that miss what we regard as consensus. So that's consensus means what the market is expecting, and if it comes in lower than what the market's expecting, it's a bad number. And we had, out of the major releases last week, I'd say we probably had 8 bad ones and 2 goodish ones. So not really particularly positive at all, and the market was under pressure. When I say the market, stock markets is what we tend to refer to without reference, but certainly stock markets, the likes of the S&P, the Dow.
It was a massive, or a bit of a recovery for some reason on Thursday, Friday, but Tuesday, Wednesday was
Tuesday, Wednesday, very much under pressure, poor data, the impeachment hearings as well weighing on sentiment, and then Thursday, Friday, the rumours of US-China trade talks resuming again this week, which I'll get onto in a second, which really helped the market recover. And we actually did have an okay employment number from the Bureau of Labour Statistics in the United States. So, and I get asked this all the time. It looks like a red number, which is confusing.
Close enough, I guess.
Well, actually, the reason why it was regarded as a good number is they've revised the August number. So they revised the August number up by 38,000, and the September number of 136,000 jobs was only, 10,000 shy. So net, it was quite positive. I think that helped the market rally to the close on Friday evening.
Yeah, I mean, we talked about those revisions last week for GDP data, didn't we? About how actually when they're trying to compile this data, sometimes it's pretty impossible to actually have all the data there for the data release, especially since sometimes non-farm payroll data is on the first of the month. I mean, how are they going to possibly have all the data in by then?
They can't, and they don't. And that's the reason why you get revisions, and sometimes they'll revise other months as well. But what Forex Factory do is they'll tell you what the previous release was revised by, and that was significant, and that's the reason why the headline might have looked, you might have thought it was negative, i.e. the 136,000 jobs, but actually net it was all right, and an unemployment rate 3.5%. We're talking about multi-decade lows in terms of employment, which is unemployment, which is extraordinary.
I mean, then the impact on the dollar, for example, wasn't massive movements really, was it? You can see the euro, so euro rising against a sort of a falling dollar, and you can see a dollar here on dollar yen, dollar Swiss. So generally down candles for the dollar on Friday because of that, really, but not exactly,
I think
not serious.
I think we're just sort of treading water ahead of the Fed minutes on Wednesday, finding out exactly what they did say in their meeting when they cut rates at the end of September. I see the dollar strength remaining, I've got to say, but time will tell. It's not for me to pass judgment on it, but I think any pullback in the dollar seems to attract further buying, and I think the funds are generally quite long on the dollar.
Well, let's have a look at what's you mentioned stuff for next week. Let's have a look at next week, shall we? There we go.
Yeah.
So there's quite a bit this week, really, isn't there?
Yeah, there was. It was an odd week last week. We often take our cue in the morning now, not just from the US close, but also what happens in the Far East. They had what we called Golden Week in China last week, and we mentioned it in the podcast last week. It's National Day, so they had closed their markets literally from Tuesday all the way through to the end of the week in China. And they also have another holiday today, so not content with 4 days last week, they're slotting in another one on Monday. But without that, there's not a huge amount. After non-farm payroll, the following week tends to be a bit bereft of data. There's a lot of central bankers talking. I know we've got the chairman of the Federal Reserve, a chap called Jerome Powell, or referred to as J. Powell. He's speaking a couple of times in the next 2 days. A weird one tonight at some film launch, which I sort of suggest is probably irrelevant. I'm not sure why people are talking about that as a possible high impact number, but certainly tomorrow Jerome Powell is talking again, but it's going to be after our markets have shut, just close to 7 o'clock in the evening. And of course this is an important week for Brexit. We know that Mr. Frost, the UK representative, is meeting Barnier today, who's the lead negotiator for the EU regarding Brexit. You'll see all the headlines. Macron's giving it a week until the end of the week, I should say. It's reading between the tea leaves, I'd guess that the UK delegation have got an air to compromise to a certain extent.
Yeah. It certainly sounds like that when you sort of read the articles coming through now. There certainly seems like we're trying to get some concessions. It's a question of whether EU can, meet us halfway, I suppose.
Yeah, that's right. And history suggests that the EU tend to make deals, and on the 59th minute of the 11th hour of the very last day. So, and I think what Boris Johnson's trying to do is, it sounds ludicrous to a certain extent, but he's telling the EU that they're going to make they can't make the mistake thinking that we won't leave on the 31st of October. But it's a bit weird, really, because you've got this Ben Act that says the Prime Minister has to ask for an extension to Article 50 by the end of next week if he hasn't got a deal. He says he's going to do that. Geoffrey Cox, the Attorney General, said he'll do it, and if he doesn't, I'm resigning. And he said he will do it, and yet at the same time he says we are leaving with a deal or no deal by the 31st.
Yeah.
They don't want to reconcile both.
Yeah, that's right. Definitely, from what I've been reading, it does seem a bit strange. It's almost as though they don't think the extension will be approved by the European Union.
Yeah, it was interesting. We discussed this before we came on air, Adrian, and there was an article, I think it was in the Telegraph over the weekend, that has highlighted something that has been rumoured for a while, that the Hungarian president is prepared to veto the request from the UK, and without all 27 members agreeing to the extension to Article 50, it won't happen.
What would his motivation be for doing that, though?
He doesn't like the EU. We could have an Huxit, Huxit following Brexit, but it's all just complete guesswork at this stage. Certainly in terms of the hacks at the Telegraph, etc. But there's no proof of anything. He hasn't commented on it at all, and I think my guess is, it's possible we could get to a situation where we do start to get some sort of a deal. They haven't agreed the principle of an agreement before they get into what they call the tunnel negotiations, where they focus on the detail. And at this stage, it's anyone's guess. And it sounds mad, But that's it, and I hate guessing. And for that reason alone, I wouldn't trade sterling, any of the sterling pairs.
Well, it's interesting because we've been sort of put a bit of a veto, if you like, of our own on sterling pairs for the last few weeks, really, just because of the volatility that such news could create. I mean, we talk about volatility a lot, and volatility often is a very good thing for trading. You know, it creates movement creates opportunity, and so on. But when you have something like this that can create such a shock, you know, you can have the market gap up and gap down. And gaps are where, you know, things can get a little bit iffy for traders. I mean, you look at the pound. You know, you wouldn't necessarily suggest there's a lot of volatility there, just some relatively normal movement, I suppose, a few big candlesticks and so on. But the danger, of course, is with a deal or a no deal, the likelihood is when that becomes concrete, you're going to get a big movement in the market there, and that can create slippage. So, Jerry, you know, let's say that we get a deal or a no deal or whatever. What do you think the impact on the pound might be?
I find sterling fascinating because if you look at a monthly chart, it's fallen so far for so long. It's so beaten up. I mean, and if you extend it all the way back, we can see where it's fallen from. Back in July 2016, and then it fell sharply in, I think it was September time. I mean, we've come a long way. Anyone or any business, any institution, any fund manager who wants to take action will have taken action by now. So you've got to ask yourself the question, who is left to sell this? What is going to be the reaction? Are people so, how can I say, removed from the situation that they haven't thought about what might happen? Of course they have, and they've taken their own action already. I think the likelihood is, I don't know what the outcome will be, but if there is a deal, my view is that you'll see sterling rebound back up to those peaks in 2018, so up to the 140, 145 level. Yeah, I'd say.
And the issue with that is that's likely to happen in sort of one shock movement
100%,
almost. A bit like when we had the Brexit referendum in the first place. I mean, that was
we went from
a remarkable move.
Yeah, 150 down to 118 really.
Yeah. It was a massive move, isn't it? Yeah. And the danger, of course, with that is that if you are short and you've got stop losses in and so on, you think you've got that protection there. Unless it's a guaranteed stop loss, you're going to get something called slippage there, or slipped, because what will happen is you'll be matched. You'll have to buy that to close, and you'll be matched with the first available seller, and they're not going to want to sell down at 125 when they can sell at 140. And the danger is that you have a whopping great smell on your account, really. That's
it will be just ghastly, and it's just not. There's no point exposing yourself to the risk. In terms of trading sterling, I see no problem in trading sterling in the run up to an event, or trading anything in a run up to an event. But I think we're now the 7th of October. The likelihood is we're going to have something happen by the 31st of October.
And the point really could happen kind of at any time, couldn't it? Really?
Well, they could announce a deal tomorrow.
Yeah.
I mean, it's highly unlikely, and of course I think it is highly unlikely, but if they do, I don't want to be short, do you?
No. And of course you can have a guaranteed stop loss with your broker, but you probably want to check actually whether they're even going to honour those. Maybe they won't allow guaranteed stop losses over this anyway. I don't know.
I wouldn't.
You know, certainly those are the types of orders that traditionally only market makers would offer anyway. So straight through processing brokers typically don't offer guaranteed stops. Either way, you've got to take your own view on the risk side of it, haven't you? Really, and I think for the vast majority of us who don't have like this big macroeconomic issue, it's probably best to sit on the sidelines. I think.
Yeah, I'd say
really, and fight another day. And of course, to the downside, if no deal's done, you will get a shock. You know, further down, won't we? But I guess probably not quite to the same extent as the shock potentially
that's right.
up.
No, because sterling move over the last 3 years reflects the possible
risk of a no
deal.
Yeah.
If there is a no deal, it probably will trade down to the sort of 110, sub 110 area. But it's quite skewed, isn't it? So if we're trading at 123, it goes down to 110, or it goes up to sort of 140, 145. The risk, as I see it, is to the upside, really.
Yeah.
And it's interesting about interest rates as well. We've heard Mark Carney and other members of the Monetary Policy Committee talking about what could happen with a deal and no deal as regards interest rates. And remember, that affects all of us. Our savers, you know, there's quite a lot of savers out there. Our rates, what are we at? 3/4%.
Yeah.
I mean, at least we've got something to cut, unlike the Eurozone, unlike the Swiss National Bank, unlike the Bank of Japan. We have actually raised our rates, albeit not by much. I think the idea that we might end up cutting rates if there's a deal, as well as cutting rates if there's a no deal, just doesn't chime right with me. My suspicions are no deal, then we probably will have a rate cut, which is probably a good idea to try and help any businesses that may be suffering as a consequence of Brexit. The consequences we don't know what will be. The government's gone a long way to try and negate a lot of them. Likewise, if there's a deal, the argument goes that we're in a bit of a parlous state globally. A lot of central banks are now cutting rates. The Eurozone, Australia and New Zealand banks are cutting rates. US Central Bank, the Federal Reserve is cutting rates. So are we going to join them? I don't know. I think there's a lot of pent up some demand in the UK that might be satisfied over the next quarter or 2 quarters that would not allow a rate cut.
Maybe our GDP data might shed a bit of light on that on Thursday, perhaps, going back to sort of the more normal and mundane
We don't tend,
bit of it. But
people don't tend to watch that monthly data so much, the quarterly data that they prefer. But anyway, that's a good idea. Let's have a look at the data again, because that's what I'm supposed to be talking about.
Interesting, a little bit anecdotal this really, but I certainly got a letter from Barclays a couple of about a month ago or so about them cutting rates on their savings and everything. You know, so they're all getting ready for something.
Well,
that's for sure.
What's happened is when we talk about interest rates, we're talking about like the cash rate, as it were.
Yeah.
But longer term rates have been coming down. So that'll be reflected in cheaper mortgages possibly. But for someone my age, I'm more concerned about my savings rates.
Yeah.
And they've been cut. I don't know whether anyone listeners bank with the likes of Marcus or Aldermore, these challenger banks that offer very good deals, they're already cutting their rates. And they cut them pretty quickly. So anyway, that's the sort of thing that has been happening with what we call a collapse in bond yields that's happened across the board, really, not just in the likes of the Eurozone and the US. It's happening in the UK. It's happening everywhere.
Okay, so for the week ahead then, Jerry, what are the key things we need to look out for? I mean, the thing that really jumps out at me is the FOMC meeting minutes. Yeah,
that's right. Yeah, so FOMC, Federal Open Market Committee, they meet monthly-ish. Well, there's 8 of them a year. They always refer to as the monthly meetings. It's like our Monetary Policy Committee for the Bank of England here in the UK. So they are charged with setting interest rates in the States. The minutes are published roughly 2 weeks after the previous meeting, which was at the end of September, and they're basically going to tell us exactly what the bank, the central bank was thinking, the rate setting committee was thinking when they cut rates. Because I don't know if you remember, when they made the announcement, they said that was it for this year. In fact, they said that's it for next year.
Well, we talked about it last.
Rate cuts.
We talked about it last week, didn't we? And then when we looked at the countdown to the rate cuts, I mean, what was it? Last one, like an 83% likelihood. When we talked last week about there being at least one cut before the end of this year.
Yeah, that's right.
Basically,
it would be some surprise if they didn't cut rates again at the end of this month. So,
I mean, actually, the likelihood is even more now. I mean, you're looking at around 90% likelihood. Yeah. So actually, from about 80 to 85% last week to 90% now.
What that's actually showing is also we're currently looking at the contracts forward contracts that basically say what the rates are going to be at a given time in the future, and for the 11th of December meeting, that's the last meeting for the FOMC this year, there's a 44.7% chance that rates will be at 125 to 150, 1.25 to 1.5%. They're currently 1 3/4 to 2, so we're talking about a half-point cut, which is quite a lot more than no cut.
Yeah.
So there were a couple of dissenters in the FOMC committee. One dissenter saying they didn't want to cut rates. Another dissenter saying, I think it was wanting a half-point cut. So whilst they agreed the press release, it's not all plain sailing at the Federal Reserve. So the market will be keen to see what they have to say in these minutes that are released at 7 o'clock on a Wednesday evening. We'll have probably finished most of our trading by then, obviously, but we'll have our stuff to discuss at 9-10 o'clock when the positions go on. And a lot can happen.
Yeah, absolutely. Definitely, anything really to do with interest rates is, for any traders worth keeping an eye on. It's likely to create that bit of movement there, for sure. Anything else, Jerry, in there?
Yeah, we got obviously we talked about Jay Powell talking. We got our own Mark Carney talking. He's the governor of the Bank of England, which is that is something we'll take note of, and has the potential to move our sterling markets. We've got inflation data in the United States. That's the core inflation data. They remove the more volatile food components from it, so that's why it's referred to as core CPI. Consumer price index, to you and me, that means inflation, or as far as the market's concerned, a lack of inflation. We have no inflation in the Eurozone. I think the last number was something like 0.8% with a target of 2%. We're down at 1.8% here in the UK. In the US, it's virtually negligible.
And this is the weird sort of paradox that usually if you've got the unemployment data like we have announced last week at 3.5%, you'd expect some pretty high inflation data, and it's just not there, is it?
Well, and the reason being, if there's a tight labour market, i.e. most people are in work, companies typically then struggle to employ people. What they do is they offer more money.
They have to pay up for it.
They have to pay more. But we're not seeing that happen in US employment data. Average hourly earnings is not going up much at all. And until the working public have more money, they're not going to spend more, they're not going to pay up for goods and services, there will be no jump in inflation. It is a bit of a paradox, really. It's flying in the face of normal convention, but we're still suffering the consequences of this great recession, and this is one of them. High employment, no inflation. There we go. Makes
the job a bit harder for the central bankers.
Who'd want to be a central banker with all that money, with all that pay?
Actually, I have no idea what they do get paid, but I'm sure it's a bit. I'm sure it's a reasonable amount.
Yeah, I think it's a fair old whack, and good pension as well. That's
quite. Okay, so anything else we want to go through today? And I know one of the topics we wanted to talk about last week, but we sort of ran out of time, was talking about volatility. But is there anything else we want to get off our chest before we get into that?
Well, we often sort of talk about economic data, and I know we said that perhaps we wouldn't spend too much time talking about it, but we often are referring to consensus, we're looking at actual data, we're looking at revisions and stuff. Why does this all matter? This is something that tells the market traders and investors how well or how badly the economy is going, and without that feedback we have no idea. And you'd think it was a conspiracy to cause volatility in the markets, the release of all this data, but actually it's a way of communicating to the wider public and the investing community how things are going. Various companies, they release the results quarterly, half yearly, annually. This is important because it informs the investor to make sure they've got all the facts in front of them. How is growth doing? How is inflation going? How's employment going? And the important thing is the market has its own idea about where these bits of information are going to come, whether they're going to come out at 1%, 2%, 3%, whatever it is. And I keep telling people, and it's so important, do not try and work out for yourself what the likely impact will be. The important thing is work out what the market is expecting. If a number is weaker, it's generally bad for the stock market, bad for the currency. If it's stronger than what was expected, you can still have a stronger number that is still weaker than the previous one. It's what was expected.
It's priced in,
and it's very easy to follow these numbers, and there are some great websites like Forex Factory that tell you what the forecast number is, and when it comes out you can even see they'll put it in red if it's less than what was expected, green if it was more than expected.
I guess the point you're really making those. You don't have to be an economics whiz to be able to sort of cut through this. It's more a question of knowing where the potential banana skins are, where the things are that can create the movement in the market, and you just trade accordingly. You trade around it almost as much as anything else. Because with all this stuff going on, what does the impact often have? You still have this is the monthly chart, of course. Think of all the different bits of data that have happened over that period of about a year there. You had a significantly straight move up. So I think a lot of the time it's all transferred into the chart, or all the time it's transferred into the chart. So it's more about being aware of where the markets could find a turning point and where the risk might be slightly increased. And that's when we talk back to the thing with Brexit at the moment, and the danger perhaps of trading some of those sterling pairs, is that if we were to see a big move there, let me just change the time frame back to the daily. And this is something I think a lot of people don't necessarily understand, is that if you put an order in, let's say you saw, you were talking to Jerry earlier, talking about it going up to 140 or maybe down to 110. What some people would naturally then want to do is say, okay, well, if it breaks up, why don't I just put an order in, I don't know, say 124, and if it goes up to 124, I can buy it and it will carry on and break higher, like joining the party as it rises. Similarly to the downside, putting an order down, I don't know, below 122, to say, right, if it starts to fall, if basically we have a no deal, we'll get the sell order away at 122, and then we'll ride it free money all the way down to 110. Unfortunately, because it's likely to jump in one go, you're not going to get your order in at 122, because what happens is you have to be matched with someone on the other side of the trade. So if you're trying to sell at 122, someone has to want to buy it back off you at 122. And if the market jumps straight down to 110, you're not selling at 122, you're selling at 110, and then you might be holding a pretty duff trade as the market, maybe it bounces back up quite quickly. The point is it's something to be aware of, and trading a sort of a bracket around that, expecting some major volatility, might be a slightly dangerous thing to be doing there.
Yeah, and what's very clear, when these numbers come out, the market never moves in a straight line anywhere. The market's sort of, it breathes really. It's inhaling and exhaling, to use a sort of slightly weird analogy, but it does that. Sometimes even when the market's obviously going in one direction, it still needs to give up. There are people looking to take profits, although they know the market's still going to go higher. They want to bank something and put it in their back pocket. It's that emotional play that comes into it, isn't it?
Yeah,
100%.
And actually, a lot of the time, if you have a big run up in the market for the whole of the week, often you'll see that profit taking materialising on the Friday. Markets will come back a little bit, and then probably resume their normal path back again from Monday. People taking a bit of risk off the table over a weekend.
Yeah, but it's interesting looking at this sterling chart. I know you were just referring to that. Last week we had the horrendous services PMI, a reading on the services sector. I think that came out on the Wednesday.
Wednesday, wasn't it?
It was that big candle there.
It's that one there.
It was that one there. You see, but it's interesting that the market still managed to rally. It might have given it back. It went above 124 at one stage, but it's still held in there. And that's often when trends develop, despite the fact that you sometimes get a disappointing number, the mood still pervades, and it's interesting how those trends are maintained. Notwithstanding the fact that I think trading sterling, as we discussed at the beginning of this piece, is too much of a lottery at this stage.
Well, it's an interesting point because, of course, the turn down on the S&Ps, the biggest index contract globally, really, was a sell trade for us back on the 20th of September. So we're already short, when the data came out. So it kind of resumed probably what was its original path anyway. It just created more speed and more ferocity in that original direction. Getting down to the bottom of this price channel and then bouncing quite aggressively. I think the VIX went down to around up to about 22, something like that. Yeah. I still feel like the VIX needs to go a little bit higher than that, but we'll see. Maybe I'm talking my own book there.
Well, we can talk about the VIX another day because it's quite a big topic. Perhaps that is something we can go into more detail next time. But highlighting or identifying a change in a trend is the most difficult part of trading. When a market is moving, anyone can see that a market's moving down or up. But when a market is going up and then starts to become a little more polarized and starts to go up and down a lot more, volatility increase, that's the tough time to try and identify what's going on.
And of course that's what we focus on with our strategies, isn't it? Those lines changing colour, the sniper discs on the chart, it's all there to simplify and identify those turning points more simply, really. Just to allow us to get on those entries, as you can see on the S&Ps there.
Yeah, and the S&P, as you said, case in point, last week we were already short. To see those moves, well, it just plays into our hands, of course, but that's a significant move in 2 days. And it's not surprising to see the market backing and filling a little bit on Thursday and Friday. And even today, although it's a green candle, that is because it's higher than where it opened, but it's still lower than where we closed on Friday. Yeah. And that's because, guess what? Traders are concerned that the trade mission to Washington, meeting between the US and Chinese trade delegates, is just not going to achieve much at all. And it's been forced on them really by the fact that there's another tariff coming in, I think on the 12th of October, on $250 billion worth of Chinese imports. And it's like, we better meet up and try and sort something out. And it's not going to happen. And it proves to Trump, by the way, that the threat of tariffs do work.
Yeah, he likes that. He likes a good threat, doesn't it?
For now, anyway.
Yeah. And is it the case that, trend signal or the indicators was predicting the data, the ISM data like this? No. But actually, it was all in the price. The trends are changing. It was all in the chart. It was all in the price. It's just a question of being able to pick that up, in as simply as possible. And that's really what trend signal is all about. So I think that's pretty much it, Jerry, isn't it?
Yeah.
Really?
That's a wrap for the days.
That's a wrap. Yeah. So guys, look, thanks for listening to today's podcast. Remember, you can post your own questions and topic ideas for our next session by emailing info@trend-signal.com with the subject line podcast. And for more live market analysis, please tune in to one of our live webinars by booking a free place on trend-signal.com. So, guys, thanks very much, and have a great week.
All the best.